Thank you, Adam, and thank all of you for joining us today. So as Adam mentioned, this presentation is based on a book that we published last year called A Practitioner's Guide to Asset Allocation. I'm not going to go through all of the topics in the book. This will hopefully just give you a flavor for what's in it. So what I'd like to do is talk about first some fallacies of asset allocation, and then after that I will talk about challenges to asset allocation. And it's it's interesting that there's so much interest in the notion of the importance of asset allocation, because that's the first fallacy that I'm going to address. So the fallacy is that asset allocation determines more than 90% of performance. And this fallacy came about because of an article that was written in 1986 by Gary Brinson, Randy Hood, and Gil Biebauer. What they did in this article is that they collected the performance of 93 large corporate pension funds, and they defined three components of performance. One was called the performance associated with asset mix policy, and the way they measured that was to take the average asset allocation of each of these funds throughout all of the years that they had data for, and then they invested it in passive indices, and the return associated with that is what they call the return due to asset mix policy. Then they looked at how each fund's asset mix varied through time from the long-term average, and they computed the returns associated with these variations, and they attributed that to market timing. So that was the second component of return that they measured. And then what they did is they looked at the actual return of the funds, and that return net of the other two components is what they attributed to security selection. So in the case of asset mix policy, it was the average asset mix invested in passive benchmarks. In terms of market timing, it was the variations from that average mix invested in passive benchmarks. And in terms of security selection, it was the actual securities held in the fund. And what they did then is they regressed the total return on these three components. And they discovered that based on these regressions, that on average across these funds, that 93.6% of variation in performance was attributed to the asset mix policy. So this is why, this is where this notion came from, that this notion that asset allocation is so much more important than security selection. Now, there's a problem with their approach, and it's actually more than a problem. It's a fundamental flaw. Their methodology implicitly assumed that the investor otherwise would not invest. So in other words, they didn't come up with a default asset mix. So for example, what they should have done is they should have observed that a particular fund's asset mix policy was, for example, 70% stocks and 30% bonds, and that the average across all funds was 60-40 stocks bonds. So the return due to that fund's asset mix policy would be the difference between the 70-30 versus the 60-40. But they didn't make that adjustment. They implicitly assumed that the money was uninvested, not even in treasury bills, uninvested. And so that's why they got such this huge, they showed this huge importance of asset mix policy. But what they really showed is that when you invest, you incur risk. So anyway, many people pointed this out over the years in various articles in the finance literature, but the debate sort of continued on. So what we did in our book is something pretty simple, but we think it dispositively addresses the question. So what you see in this table are, it's a hypothetical, we have a hypothetical stock market and a hypothetical bond market. So we created this hypothetical world, this imaginary world. It's very unrealistic, but we did this just to illustrate the fallacy of the Brinton-Hood-Biebauer methodology. So in this hypothetical world, we have a stock market that has only two stocks, stock A and stock B. And the relative capitalization is 50-50. So the stock index is just an equal weighting of stock A and B. Now, what's interesting in the stock market is that during the period that we observe it, this imaginary stock market, stock A's returns each and every period were exactly twice as great as stock B's returns. Okay. Then we also assumed this imaginary bond market where we had bond A and bond B. And again, the relative capitalization was 50-50. And so the bond market's return would just be an equal weighting of bond A's return and bond B's return. And just as in the stock market, bond A's return each and every period was twice as large as bond B's return. So you might wonder, why would we imagine such a ridiculous world? Well, we did it to make the point. What you can see is that in this world, it is impossible, it's absolutely impossible to affect performance by asset allocation, because every asset mix, right, every mix between the stock index and the bond index from 100-0 to 0-100 or 50-50, every single combination of the stock market and the bond market will have the same exact return. So it's not possible in this imaginary world for asset allocation to have any effect whatsoever on performance. The only thing that matters in this world is whether the manager chooses stock A or stock B or bond A or bond B. So in this world, we have two managers. We have a skillful manager who always chooses stock A and bond A, right? And an unlucky manager who always chooses stock B and bond B. In my experience over the years, I've never met an unskillful manager, just a skillful manager and unlucky managers. So what we then did, which I'll show you, is we did exactly what the Brinton-Hood-Biebauer methodology did, which was to regress the returns of these managers on the asset class performance. And what you see is that all of the observations in these regressions, so we regress the returns of the skillful investor and the unlucky investor, and what you can see by these lines is all the returns fall exactly on those lines, which means that according to this methodology, asset allocation explained 100% of their performance. So think about it. This is the Brinton-Hood-Biebauer methodology applied to this imaginary world where asset allocation cannot possibly have any effect on performance, and the only thing that determines differences in performance would be security selection. This methodology showed that asset allocation explained 100% of performance. So the reality is that if you properly measure the relative importance of asset allocation and security selection based on performance that actually occurred, you would get something closer to 50-50 in terms of the relative importance of the two. But there's a problem in measuring the relative importance of asset allocation and security selection based on realized performance, because what you're capturing is not just the potential for asset allocation and security selection to impact results, but also the choices that investors make to emphasize one versus the other. So you can have a situation where perhaps asset allocation doesn't have that great a potential, but investors focus on that a lot. They take a lot of risk in their asset allocation. That would have asset allocation showing up as relatively important. Or you can have another scenario where investors take a lot of security selection risk, and that would show up as being relatively more important. So the way to think about this, the way that we argue one should think about it, is you have to somehow separate the potential for asset allocation and security selection to impact outcomes. You have to separate that from the choices that investors make to emphasize one versus the other. And the way to do that is by bootstrapping. So what you can do is say, let's look at all of the returns that would come from holding constant the security composition of the asset classes and just look at random asset mixes and bootstrap, hundreds of asset mixes ranging from 100% stocks to 0% stocks. And then let's look at the distribution of returns that corresponds to the range of all of those asset allocations, right, where the security composition of the asset classes is fixed, right? So you get a certain distribution of performance that arises purely from differences in asset mixes. And then what you do is you say, let's now fix the asset allocation, whatever you like, 50-50, 60-40, but let's bootstrap portfolio returns by varying the security composition of the asset classes. So in one case, you hold constant your security composition and vary the asset allocation. In the other situation, you hold constant your asset allocation and you vary the security composition of the portfolios. You generate the return distributions from those two experiments, and then you look at the relative, the range of returns associated with these two different methodologies. And if you were to do it that way, what you would find is that security selection is about 3 or 4 times as important in asset allocation. So it has 3 or 4 times the potential to impact performance as does asset allocation. Having said all of that, it's my belief that your time and energy is better allocated doing asset allocation than security selection for the following reason. It's easier to be successful at asset allocation than it is to be successful at security selection. This is known as the Samuelson dictum, named after the famous economist Paul Samuelson.